picture. We're talking real money.
We hear from a lot of people, a lot, and you hear it even if you don't listen to this show. If you watch financial television or read the financial press, a lot of proponents out there of a dividend investing strategy. That is where you buy only stocks that pay dividends or higher dividends, and you ignore all the ones that don't pay dividends, and you create an income stream from that. Now, it on the face of it, it makes perfect sense. Oh, okay, it's just like getting income from my bonds. I'm just going to collect the dividends from the stock no matter what they do, and I'm going to come out all right. Well, you might not. It's one of those kind of, it depends on what the future looks like. But as a strategy, does it make sense based on evidence, based on academic research? We have turned to a lot of people to answer this question. And Tom, what's the answer?
The answer really is no. The answer is no twice. Number one, in terms of a strategy to sort of chase down the higher dividend paying stocks and think you're going to make more than the market, does not. That, and we'll talk about the papers to support that. And then the second part of this is what came up in a recent question is, why not just have a portfolio of these, harvest this as my income in retirement? And again, the numbers don't pan out. So, a guy that I deeply respect, he writes a ton, and you can go type this in on the internet. It's available to anyone. Larry Swedroe, he just came out with a piece less than a month ago, the evidence against favoring dividend-paying stocks. And Larry says there's been no historical alpha. What is alpha again?
Explain what alpha is.
Isn't that like making
alpha,
more than...
Alpha is performance, is return over and above the benchmark.
There has been no historical alpha among dividend-paying stocks, including those with a history of increasing dividends. And this just sums it perfectly up. Investors are better served by tilting allocations to factors that have historically outperformed, like size, value, momentum, other factors that the academics can go back and look. But this comes up, and this is a lengthy paper. He even looks at particular funds. The Vanguard Dividend Appreciation Fund, which I think we've gotten emails about, has $64 billion in it. So it's no small, but he goes through all this and he says none of the 4 dividend appreciation ETFs produced a statistically significant alpha. It doesn't show up. You're not making more money
Which
by
means,
chasing those down.
Yeah.
And here's the other
You're
part.
You're not making more money. That's really people are thinking that, well, I'm going to get the return of stocks and I'm going to get these nice juicy dividends.
And I'm going to let you explain.
It's not true.
I'll let you explain how dividends work in just a moment. But here's, I think, one of the key points is, again, we told you, and you can go through, you can read all this. I'm not going to go through every part of it, but those other factors provide greater returns. The size, right? The profitability, the continuously being exposed to the market, the value in other words, being value oriented rather than growth. But here's the important part to me. You have far less diversification. What do we know about investing in stocks? Diversification is the one thing that has saved you, because when the S&P gets killed, S&P 500, I should say, gets killed, you own other things that don't necessarily go down with it. Or conversely, the other happens. So you have less diversification, you have no alpha, and what you end up with, frankly, is a lot of companies that are, at the end of the day, oftentimes riskier. Because what can look like a really great dividend yield really means the price oftentimes has come down. And that's what I was going to try to get from you, Don.
The price of the stock. Stock.
When people issue dividends, what does that do to the price of the shares?
It's a really simple thing that people don't get. Like, let's say your stock is $20 a share. And you are about to get paid a $2 dividend, 10% dividend, big honking dividend. On the day that dividend becomes payable to those shareholders, it's called the ex-dividend date. On that date, the share price is decreased by $2. So you get $2,
Yeah.
but the value of your shares went down by $2. Why did it go down by $2? Because that $2 that they paid you was essentially already built into the value of the stock for that quarter. The stock grows in value as that dividend accrues, it is assumed. And then on the day of the dividend, the stock goes down by $2. So you're at a really, for that little brief period, your net is zero.
Yeah, and this is the
Zero.
part that people don't understand. They think it's a free lunch of some kind, which it most understandably is not. It limits your diversification. Again, Swedroe and others, the academics, have shown you it does not create outperformance. And here's the other part, because this comes up time and time again. Is it better to turn on the dividends, collect all these dividends, or let them ride, buy more shares, own more of all this, and then have a total return strategy when you sell the things that have gone up, et cetera? That total return strategy has been better than pulling the dividends. So you may feel great because, look, I get these 3% from my portfolio, et cetera. It's not the best way to create the portfolio nor harvest your winnings from the portfolio. That's the point I wanted to make. I tried to make that when we had the caller last week, but I don't think we did that well on the air. I'll put it that way.
Well, and it's sometimes very, very difficult to, when someone has got something in their head.
And that was true of that case.
It is almost impossible in a brief conversation, when someone has something that they believe fervently, it's really hard to convince them otherwise. And he was defending his belief system, even though his belief system has been proven to be wrong in aggregate. You see, we can't deal. That's the problem of dealing with individual cases. Is they're anecdotal. They're not evidence. They're just a story. Now, the reality is the numbers, the research shows that there are really two great ways to build and take income from your investment portfolio once you reach retirement. Two really good, proven, tested ways. Nothing is foolproof. Nothing is absolute. Please bear that in mind. However, the trick is to build the right, and we say this over and over again, it sounds just so rote, to build the right portfolio for two things: your tolerance for risk and your need to take it. You don't want to take more risk than you need to live. And then from that portfolio, and we found this works with almost anyone, but bear in mind, the more aggressive the portfolio, the more stocks in the portfolio, the more money you'll probably have to leave to your heirs if the market acts like it has in the past. But in almost any scenario, as long as you had some equities in the portfolio, you could withdraw 4% per year plus inflation every year and not run out of money.
And nobody believes that anymore.
But it's true.
They don't believe it.
It's been true. We should say.
When the market goes down, Don, I can only take 3.75%. How long are you going to live? Till next
4.
January? I mean, this is ridiculous. You're going to live far longer than that. And the market's going to go up and down.
The market is, this is the thing, is when it's going down, this is that psychology. When the market has been going down, people believe it is never ending.
Yeah.
So I'm going to be withdrawing 4% for the next 20 years. Well, it's done. I'm done. I'm in trouble. No, you're not. And the other thing that works really, really well, and we've run these numbers over and over again, is what we call the flexible withdrawal. And I looked back at my Social Security earnings over the past 40 years.
Speaking of flexible.
And I looked at it and I went, how did I survive those years? Woo, I made no money. How did I survive those years? Flexibility.
Yeah.
So take a flexible withdrawal. When at the beginning of the year, this is so nice because you're going to know your budget anyway. Take 5% of the value of your portfolio out at the beginning of the year and go, honey, that's what we have to live on. That plus Social Security. There we go. Do it. It's easy.
I think that's smart. And again, I really struggle. This just feels like one of those things that I have a trick that nobody else knows about, and that I'm getting something for nothing. I'm getting something. You're not getting it. Yeah, I'm getting it. those things all go into my portfolio. They buy more shares of those funds, and I do get it. So that's a silly, it's misplaced. So, all right, we got time for a quick question or two here.
Yeah, absolutely.
Okay. I like this one.
Just don't make them hard.
Okay, this is pretty easy. This comes from Joe in Maple Valley, Washington. I'm going to list my house soon. I can expect some profit, around 150 to 200,000.
Oh, wait, let me guess. What should I do with the money?
I would like to use the money to contribute to my traditional IRA for the next 15 years or so. I'm 53. I don't have access to a 401k or any other retirement accounts. My question is, where should I keep this money from the sale? My traditional IRA is at Vanguard, globally diversified in index mutual funds at 80% equity, 20% bond. I think that's great. I also have a brokerage account with Vanguard. I keep my emergency fund in the money market there. Should I replicate my IRA portfolio and invest in a brokerage account? Should I then transfer the max contribution amount to my IRA each year, or should I go more conservative with this funding money? I love your show and never miss an episode, says Joe. Thank you, Joe.
Joe, you just said it. You know what to do. You just hesitate because you think, well, there must be something wrong with this. It just seems too easy. No, this is all way too easy, Joe. You replicate what you're doing because the money is going into the IRA. The minute it goes into the IRA, it's going to be 80-20, right? So why not have it 80-20 to begin with, and use ETFs so that you don't have to worry about capital gains until you move it to the IRA, which you because you're going to have to get out of them then.
But you will.
Yeah, okay. Replicate it.
Yeah, the portfolio part, easy. Keep doing that. The only question I have for you, Joe, is, as you're 53, have you thought about how big each part of your holdings, in other words, how much in pre-tax, how much in Roth, and how much in post-tax? Because this is something we're going to discuss in an upcoming podcast, and that is really being careful about your taxes in retirement. There are ways to actually be, I was shocked when I read the piece, because it's not me, zero taxes in retirement. So there's reasons to hold money in a brokerage type account that may make sense to you rather than piling it necessarily into the IRA. But other than that, Don's right. The portfolio sounds great. I'd keep at that part.
And here's the thing. You might just want to build that portfolio, as Tom said, outside of that IRA and find a way, because IRA contributions are not that big anyway. Find a way to make that contribution out of
$7,500 this year.
Yeah. For over 50.
Correct. Really old people.
Find a way to get that $7,500 from other income. So that you're building both an IRA account and an account outside of the IRA, and again, use ETFs because they give you in essence aggressive growth ones. Do the most aggressive, the least dividend paying outside of your IRA, and then you're going to get some tax advantages from that. So yeah, I think you're on the right track.
Absolutely. Thank you for listening. Appreciate your kind comments. That was Ron.
Do you have any more?
Don over there. Do I have any more kind comments? I'm pretty more worn out on kind comments for the week.
You haven't given me any. I don't know who's getting them, but it hasn't been me.
Well, Ron, you know that questions? Happens. Oh, questions.
Do you have any more questions?
Yeah, I do have another question. But all right, we'll do this one. This comes from Jason.
I mean, we have time.
This comes from Jason. In Nashville. Mm-hmm. He said on the March 30th.
My daughter flew through Nashville last night on Southwest.
Apparently everywhere else on the Eastern Seaboard or Midwest too,
exactly.
Right? So, Jason writes on March 31st podcast, there was a question on backdoor Roth and what strategy someone can use if they have a traditional IRA and want to avoid the pro rata rule, which says if you're trying to do a backdoor Roth and you already have a traditional IRA, you have to move a pro rata amount of the IRA to the Roth and pay tax on that. So it's really, when you have an IRA and then you're trying to do a backdoor, it's a little tricky. Answer is simple. Just roll. This is pretty smart. Roll the traditional IRA into an employer 401k. Most 401ks will allow you to do this. You avoid the pro rata calculation and can do the backdoor Roth without issue. 401ks are not considered IRA money. Hope this helps. Take care.
Right. It does help.
Yeah.
And but again, that's a question that only works in specific instances.
Indeed.
When you have two things, you have an employer 401k.
Good point. Yep.
A lot of people don't, and you have one that allows you to move money into it, other monies, because they can
Which
restrict
they don't
that.
know. Yes, they can. I don't know that I've ever come across one that has, but why would they? They want the money.
The fact of the matter is, I love it when we get these because they're very helpful. But for us to add them to our answers, sometimes
that's
the
true.
answers become a little ponderous. They become but maybe you can, and it
depends.
But generally speaking, because we've had somebody yell at us for not emphasizing the pro rata rule enough. You didn't tell me that I had to. Yeah, well, you know what? We can't cover everything.
Little known codicil. Yeah, got it. Yeah.
It's just not possible. In the disclaimer, we say this is for just general advice for educational purposes. We're not trying to be your spiritual guides or financial guides. If you want that kind of help, then you need to go to one of our fiduciary advisors and spend money, or you can actually even talk to one for free. Just go to talkingrealmoney.com and click Meet an Advisor. Someone in our firm at Apello Wealth will talk with you and will provide you with help and won't try to sell you anything. Promise.
Wow, that was really good. I can't even add to that. That's so good, Ron. I'm going to step aside.
No, you're Ron, remember?
Dang it. They didn't give me the... Okay, yeah thank you.
He used to be the smartest guy in the room. He's been replaced by
somebody else came and sat down in front of me.
Well, Tom Cock has been replaced by Tom Clock.
Well, that's probably accurate because I am pretty good on time most of the time. So,
yeah, you were 23 seconds late for our call this morning.
Yeah, I could tell.
23 seconds.
It hurt you deeply. I could tell.
Yeah. And if you want to call us with questions, 855-935-TALK is the number. Remember, you can call us live on Saturdays from 3 to 5 Eastern, noon to 2 Pacific, 855-935-TALK, or check out everything at talkingrealmoney.com. You can ask us questions there, and it's a really very, very helpful website. Thank you for being a part of our program. For Ron Clock, I'm Don McDonald, Talking Real Money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.